Hello everyone, my name is AishwaryWanjari and today I'll be discussing the India's twin balance sheet problem, which is a barrier to economic growth. India's economy has grown rapidly over the last few decades, but a major financial issue has held back its full potential. That is the twin balance sheet problem, that is also called as TBS problem. This refers to the simultaneous financial stress on two critical sectors of the economy, banks and large corporate borrowers. When companies can't repay their loans, banks suffer from the bad debt, limiting their ability to give new loans. This problem has slowed down private investment and overall economic growth. In this video, I'll explain what the twin balance sheet problem is and how it affects the economy, what reforms have been taken, and what more needs to be done. The twin balance sheet problem became serious after the early 2000s when the banks aggressively lent money to the companies, especially in infrastructure, steel, and power sectors. Many of these projects faced delays, cost overruns, and lower than expected revenues. As a result, corporates accumulated high debt and couldn't repay the loans, leading to rising non performing assets. Banks, especially public sector banks, saw their balance sheet weaken because of the rising bad loans. By 2016-17, the problem has reached alarming levels. The Economic Survey 2016-17 called it the festering twin balance sheet problem, and the gross NPA ratio of Indian banks had risen above 10%, among the highest in the world. The twin balance sheet crisis has serious consequences. The credit crunch. Banks burdened with bad loans became cautious in lending, slowing down credit growth. Investment slowdown. With lower credit availability, companies struggled to invest in expansion and it affected the economic growth. So it also resulted into banking sector weakness. Public sector banks, which dominate India's banking system, needed government support and recapitalization. A weaker banking sector also affected monetary policy transmission, meaning even when RBI lowers the interest rates, banks are hesitant to pass to the benefits to the businesses and consumers. Let's focus on the reforms taken to address this problem. To recognize the seriousness of the issue, the government and RBI took several steps, including Insolvency and Bankruptcy Code (IBC 2016). This law aimed to resolve bad loans quickly by allowing companies and banks to either restructure debt or liquidate assets. Before IBC, resolving a bad loan in India took years. Now, it is expected to be done in 180 to 270 days. Recapitalization of public sector banks. The government infused over 2.1 lakh crores into public banks between 2017 and 2019 to strengthen their balance sheets. Asset Quality Review, or AQR. RBI initiated this to ensure banks correctly reported bad loans instead of hiding them under restructuring schemes. Regulatory forbearance. A temporary measure which was taken during the COVID-19 pandemic, RBI provided loan moratoriums and restructuring options to prevent a new wave of NPAs. While these reforms have helped, challenges still remain, which includes slow resolution under IBC, weak credit growth in the private sector, and new NPAs emerging, like during the sector, like real estates and small businesses still struggle with financial stress post-COVID. In summary, the twins balance sheet problem has been a major roadblock to India's economic growth, while reforms like IBC, bank recapitalization, and creation of NRA-CL have helped. Long-term solutions are still needed to ensure strong financial sector. As future business leaders, we must understand these macroeconomic challenges and contribute to the sustainable financial growth. So, what are your thoughts on India's banking reforms? Comment down below. Thank you.